Okay, let's unpack this. We are diving into, well, one of the most high-stakes real estate decisions happening in the Asia-Pacific right now.
It really is.
The subject's a Hong Kong property, but specifically, it's about a developer placing a massive contrarian bet against a very, very negative market trend.
It's the definition of a pressure test. I mean, we're watching V Group, which is led by its founder and chairwoman, Vivian Chan,
Right.
and they're pushing forward with the sale of their absolute prime inventory. We're talking luxury serviced apartments, super deluxe houses.
And they're doing this at a moment when nearly every economic indicator says they should be pulling back.
Yeah, waiting for the storm to pass.
That's the tension point we're really focused on today. Our goal is to cut through the immediate narrative of, market doom and gloom and figure out the core strategy here.
Mm-hmm.
Why is V Group choosing this specific moment to list flagship properties? I mean, what analysis are they relying on that lets them just disregard what looks like a widespread market collapse?
And I think for you, the listener, this isn't just about Hong Kong. This is kind of a masterclass in market segmentation.
That's a great way to put it.
It really forces us to ask, is this move a desperate attempt to, shore up capital before things get worse? Or is it a calculated long-term belief that truly prime, high-quality assets operate on a whole different level?
Outside the rules of the general market.
Entirely.
So let's set the stage, because understanding the economic environment that V Group is navigating is, well, it's everything.
It's the whole context.
Here's where it gets really interesting. The latest data shows Hong Kong home prices have declined to their lowest point in roughly 2.5 years as of July.
Which is a sustained, grinding decline.
Yeah, yes, in a city that's historically just defined by, exponential property growth.
And that figure is staggering because Hong Kong property has long been treated as this untouchable asset class. It's almost like a currency hedge for regional wealth.
Yeah.
The downward trend has been pretty consistent ever since prices peaked back in September 2021. So this isn't just a minor dip. It's a real correction that has bled into pretty much every segment.
And when you look at the primary cause, it's not hard to spot. But the mechanism behind it is what's really crucial to understand.
Right.
The biggest driver of this whole downturn is significantly increased borrowing costs. We can't just say interest rates went up and leave it there, can we?
No, because there's that direct link.
Huh.
Hong Kong's dollar is pegged to the U.S. dollar.
Exactly.
And because of that peg, when the U.S. Federal Reserve started aggressively hiking rates to fight inflation over the last couple of years, the local rates, specifically HKIBOR, they were forced to follow suit.
And that's been a massive shock to the system.
A huge shock. It instantly drove up mortgage payments for millions of borrowers who had enjoyed, years of near-zero rates.
So if you are a buyer relying on local financing,
which is the vast majority of them.
right, the vast majority of general home buyers,
Mm-hmm.
your purchasing power has just been completely decimated.
That sudden surge in monthly debt servicing costs has just, severely dampened buyer demand across the board.
And Vivian Chan herself, to her credit, she acknowledged the complexity here. She noted that the prolonged impact of the COVID-19 pandemic also played a pretty big role.
Yeah, well, it wasn't just a credit crunch. It was a lingering sense of economic uncertainty, slowing transactions, hitting market confidence.
Okay, but hold on a moment. We've established the entire market is suffering because of these high borrowing costs.
Right.
If that's the case, why would any rational high net worth individual, or a corporate entity for that matter, buy a multi-million-dollar property right now?
It's the essential question.
Couldn't this whole launch be seen not as confidence, but as a calculated, maybe a distress sale to generate cash before prices fall even further?
And that's a perfectly valid question. If V Group were selling, say, second-tier, poorly maintained, or less strategically located assets, that distress sale narrative would be highly plausible. But the specifics of their inventory, what they're actually selling, points in the complete opposite direction. They're differentiating their product so profoundly that they're targeting buyers who are largely immune to local borrowing costs.
So what you're saying is they are segmenting the buyer pool entirely. They're aiming for people who don't need HKIBOR-linked mortgages.
Precisely. We have to remember that ultra-high net worth individuals, especially those using cross-border capital, they often use different forms of financing or, well, they transact in cash.
And for them, a dip is an opportunity.
A temporary 2.5-year dip is a potential buying opportunity. And for corporate clients who are seeking premium extended stay solutions, the transaction is often an operational cost, not a financing burden.
Which brings us directly to what they're actually selling.
Exactly.
Let's transition into that. What exactly is V Group putting on the block? Let's start with the properties that cater specifically to that corporate and extended stay clientele.
The service
The
departments.
service department.
And this offering is fascinating because it targets a very specific functional need in the Asia-Pacific market. We're not talking about traditional residential homes here.
No.
Service departments, like the ones V Group is selling, they function as flexible, fully furnished corporate housing.
Move-in ready.
Exactly. It's the ideal solution for business travelers, entrepreneurs, or corporate teams that need comfort and convenience for stays longer than just a few days. Think 3 to 6 months.
And the asset in question is truly prime. V Group is listing 64 of the 120 fully furnished units at their flagship project, the Hayworth by V.
Which is right in the heart of Causeway Bay.
The beating heart. It's at 9 Yi Bo Street, right near the MTR station. And in Hong Kong, being directly on the MTR is, well, it's non-negotiable for business efficiency.
That operational efficiency is absolutely key. For a company sending an executive team to Hong Kong for a long-term project, using a premium service department, it just minimizes the headache.
All the logistics.
And the operational risk that comes with a traditional long-term lease. It's ready to go, it's professionally managed, and it usually includes all the essential services. It's a low-friction entry point for capital.
But the real kicker here, the thing that I think proves V Group's commitment to quality over just market timing, is the money they just spent.
The capital expenditure.
This development, which used to be known as V Causeway Bay, recently underwent a substantial HK $200 million renovation.
That's about $25.5 million US.
Right.
And that $200 million investment, it just speaks volumes. They are not trying to offload an aging asset.
Not at all.
They are aggressively upgrading the property to make sure it meets the absolute highest modern standard before they list it. They're betting that the buyer pool for this kind of asset corporate funds, high-level investors, will pay a premium specifically for that turnkey, zero-maintenance condition.
That level of spending is so strategic. It's about insulation. If you're a buyer, paying a high price for an older building means you immediately inherit renovation risk. V Group completely eliminates that risk.
Yeah.
And that makes the proposition so much more compelling, even in a high-interest environment. The units themselves range from a compact 274 square feet up to a larger 876 square feet.
Which provides a lot of flexibility.
Exactly. For individual professionals or small corporate teams, reinforcing that whole extended stay focus.
Okay, so now let's contrast that functional, sort of yield-focused asset with the other side of the inventory coin.
Right.
V Group is also listing 4 super deluxe houses at 20 Peak Road by V, and this is in the famously exclusive the Peak District.
And that represents an entirely different investment thesis.
Totally different.
You couldn't design a clearer segmentation of prime capital. On one hand, you have the yield and operational efficiency play down in Causeway Bay, and on the other, you have the ultimate scarcity asset, generational wealth accumulation up on the Peak.
And the Peak houses are not sold based on corporate flexibility or rental yield. They're sold on scarcity, on status, and long-term capital preservation.
It's a statement piece.
It's a statement that transcends market cycles. I mean, historically, these properties are held for decades. They are minimally impacted by local borrowing costs because the buyer profile often involves offshore wealth just looking for a safe harbor asset.
It's a fascinating dual strategy, isn't it?
It is.
V Group is essentially running 2 separate playbooks at the same time. One addresses the modern corporate housing need with fully renovated efficiency.
And the other addresses the ultimate security of wealth through, ultra-exclusive real estate scarcity.
They're signaling that they believe both segments of the prime market are ready to absorb inventory right now.
Which brings us back to Vivian Chan's rationale. The source material says she remains undeterred by the downturn.
Undeterred, I like that.
And the core of her strategic confidence seems to be that a general market slump, which is driven by these rate hikes, it simply does not apply to properties that qualify as prime based on 2 criteria.
And what are they?
Unbeatable location and unimpeachable quality or renovation.
Let's drill down on that quality factor again, specifically that HK $200 million renovation. In a general down cycle, capital becomes incredibly discerning, doesn't it?
Absolutely. Buyers aren't just looking for a good price. They're looking to minimize immediate risk.
Right.
And when buyers are nervous, they're looking for that flight to quality. The renovation of the Hayworth Is V Group basically controlling the competitive environment?
They're setting the terms.
They are. They're ensuring their product is so far above the market average in its condition that it justifies the premium price, regardless of the broader economic backdrop. They're forcing the buyer to focus on the product, not the rates.
So they're making the product irresistible. It's move-in ready, fully furnished, professionally managed, which, again, directly caters to that fast-moving executive and corporate capital we discussed earlier.
Exactly. And if we connect this to the bigger picture, V Group is essentially formalizing the concept of market segmentation.
They're drawing a line in the sand.
They really are. They're asserting that the interest rate-driven downturn only applies to properties that are old, poorly maintained, or, located in less strategic areas. The moment an asset is modernized and strategically positioned near a transport hub like the MTR,
Or positioned as a generational wealth anchor like the Peak.
it transitions into a distinct asset class. It starts playing by entirely different global rules.
That's a very bold operational stance. I mean, they're not waiting for interest rates to drop back down to zero.
No.
They're saying, we have a superior product, and the market for superior products is always open.
And it highlights a crucial insight for property investors globally. The closer an asset is to essential, non-negotiable infrastructure, and the higher its level of modern amenity,
The more likely it is to retain value.
and attract international capital, even during a severe local credit crunch. That $200 million price tag is really an insurance policy against market volatility.
Okay, so let's synthesize what we've learned here. Let's try and wrap our heads around this. We started with a contradiction. A major developer selling prime property during a 2.5-year market low.
A low caused by soaring borrowing costs.
Right.
And I think the first key takeaway is that the downturn is really driven by macro finance, that HKD peg forcing local rates up, which primarily impacts the local traditional buyer.
Not necessarily the global corporate buyer.
Or the ultra-high net worth investor, no.
And V Group's calculated response to this was to list these highly specific assets targeting those insulated buyers.
64 fully renovated service departments at the Hayworth and Causeway Bay, focusing on corporate flexibility.
And the 4 houses on the Peak, which were all about scarcity and wealth preservation.
And their core rationale, which seems to be driven by Vivian Chan's confidence, is that $200 million commitment to quality and renovation combined with prime location, it just creates an offering that transcends the general market slump.
So they're betting on the enduring appeal of assets that offer minimal risk and maximum immediate value.
Exactly.
It's a fascinating moment where product differentiation is attempting to completely override these huge adverse macroeconomic forces. V Group is projecting complete control and banking on the idea that quality capital will always seek quality assets.
And this brings us to a final thought for you to mull over. The V Group strategy really confirms that in times of deep economic uncertainty, capital flows disproportionately towards assets with the strongest fundamental qualities. This is the flight to quality principle in action.
Which raises an important question for the future, doesn't it?
Yeah.
If prime real estate, particularly assets designed for corporate efficiency or generational wealth, like these service departments and Peak houses, if they prove to be demonstrably immune to a local market decline caused by borrowing costs, what does that imply about the future valuation gap?
That's a great question.
Are we entering a period where the split between prime, modern service property and general, older, traditional property just accelerates far beyond historic norms? Could it fundamentally reshape Hong Kong's real estate hierarchy?
That's something to keep watching as global capital continues to look for stable, high-quality homes.